In this video, we're going to explain how to approach the drafting and interpreting financial statements sample assessment 2, task 4. So the question asks us, the inventories of Woody Limited, a manufacturer of children's clothing, include a line of Parker coats at the accounting year end. The following information is relevant. So it tells us that the cost incurred to date amounted to £12,000. But we've also got some other information. The estimated cost to complete amount to £3,000, and there's also an estimated selling price of £14,000. Now notice they've also given us a little bit more information. Selling costs estimated at £700. So they've given us some extra information that's not included in the table, and that might easily be forgotten when you're doing the question. So you need to make sure you're looking at everything. And then the question says, calculate the amount at which the inventory of Parker should be recognised in the financial statements. Well, according to IAS 2, inventory should be stated at the lower of cost and the net realisable value. So why is this? What's the significance of this rule in the standard? Well, let's have a look at the framework to the financial reporting standards, where we've got a definition of an asset. It tells us that an asset is a present economic resource controlled by the entity as a result of past events. And it further explains that an economic resource is a right that has the potential to produce economic benefits. In other words, we're going to be earning some money in the future. So this asset is a resource for us because we're going to earn money from it. So when we think about our inventories, we need to think about, well, this is an asset for us and we've spent so much money, we've spent the cost to buy this inventory and we're going to be earning some money from it. And ordinarily, the future income from the asset will be bigger than the cost. Otherwise, we're going to be having a problem and not making any profits, because normally the selling price is higher than the cost, isn't it? But it could be that for some reason there's some problem with the selling price, and therefore we might not be able to recover the cost. So if the selling price falls below the cost, we need to be prudent and recognize that we can't earn so much money from this asset. And therefore, if the net realisable value, which is basically how much we can earn from this asset, is less than the cost, we need to bring down its value, because the economic resource that is represented in this asset has fallen. The maximum we can earn from this asset will be the net realisable value. So remember, this is the application of the prudence concept. So what do we mean by this net realisable value, and how is it different to the cost? Well, one way to think about it is that the cost relates to anything that's happened in the past, and the net realisable value relates to anything that will happen in the future. So the cost relates to all costs involved in bringing that inventory to its present location and condition. Whereas for the net realisable value, that's going to be the future selling price less any future costs to complete work on this inventory, less any future selling costs. So in this particular example, they've given us that the cost incurred to date, that's the past cost of £12,000. Whereas for the net realisable value, we've got the future selling price of £14,000. But before we can sell it, we've got to spend £3,000 on finishing the inventory. So that means that of that selling price of £14,000, we're only really going to make £11,000 from it. But also, we still have to spend a further £700 just to sell it in the first place. So the combination of all these things mean that the net realisable value is £10,300. This is lower than the cost. So that tells us that we're not going to recover the full amount of the cost, and therefore we should show the inventory at the £10,300. The second part of the question asks us to explain our answer. Well, that's what we've just done in the explanation. So there are 2 marks available for that. So it's likely that you'd get 1 mark for clarifying that inventory should be at the lower of cost and net realisable value. And then the second mark would be to clarify what net realisable value is. That's the future selling price minus the future cost to complete the inventory minus any future selling costs. The next part of the question relates to the directors of Dunstone plc, and they're preparing the company financial statements for the year ended 31st of December 20x1. Remember that if there's a date in the question, it's there for a reason, and it'll be a good idea to highlight the date using the highlighter tool in your assessment to make sure that you consider it. So it further tells then on the 10th of January 20x2, so that's just a few days later, Dunstone announced a plan to restructure the company at a cost of £5 million. And the requirement says, identify whether the announcement should be classified as an adjusting or non-adjusting event in Dunstone plc's financial statements for the year ended 31st December 20x1. So in this case, we're thinking about IAS 10, which relates to events that happen after the reporting date. So to help understand this, let's draw a timeline. So we've got our year 20x1 and then our year 20x2. And here's our year end. So there's the 31st of December. And for you, if you're working as an accountant, you'll be familiar that there'll be lots of transactions happening during the year, lots of invoices coming in, but also it's normal that perhaps some invoices will arrive after the end of the year, but they relate to goods that were purchased in the previous year. So even though the invoice arrives after the end of the year, we'll still process it as if the transaction occurred during the accounting year. So that's a pretty normal event. We also know that after the end of the year, there's a pretty good chance that there may be an audit if it's a big company, and there may be some errors discovered. So again, the error happened during the accounting year. It was discovered after the end of the year, but nevertheless, we'll still fix it during the accounting year. So in IAS 10, it's providing us with a bit of guidance now about, well, what happens if other things occur after the end of the year? Should we make an adjustment for it or not? And IAS 10 defines an adjusting event and a non-adjusting event. So it all really depends on whether the conditions existed prior to the end of the year. So we may have some new information after the end of the year, but if that new information relates to conditions which existed at the year end, then it would be an adjusting event. But if the conditions did not exist at the year end, then it would be a non-adjusting event. In the first part of the question, we were talking about inventories, weren't we? And we identified that inventory should be valued at the lower of cost and net realisable value. So let's suppose that we bought some inventory in the last week of December, but the invoice doesn't arrive until after the end of the year. Well, the inventories are there, they're physically in existence at the 31st of December, so the conditions existed. The invoice arrives after the end of the year, but it tells us what the cost was at the year end, and therefore that would be an adjusting event. We should post the inventory and recognise it in assets in the accounting year. But what about the net realisable value? As we discussed, the net realisable value relates to future events. So we can't actually calculate the net realisable value until after the year end anyway. Of course, we can try to estimate it, but it's quite likely that we will find out information after the end of the year. We can find out what the actual selling price is, we can find out what the actual cost to complete, and we can find out what the actual selling costs are. So we might be able to work out the actual net realisable value after the end of the year. But the inventory existed at the year end, so even though we get this information after the end of the year, we should still correct our figures and work out what the correct net realisable value is for the accounting year in question. So again, that would be an adjusting event. So if we discovered that the inventory that we were talking about at the beginning of the question was actually its net realisable value was less than the cost, and we can see that it is. There's we need to write off £1,700 worth of inventory, so we would need to do a double entry as an adjusting event. So we would debit our cost of sales with 1,700 and credit the inventory asset 1,700 to reduce its value. IAS 10 says that for adjusting events, we also need to have some disclosure as well to explain that something happened after the end of the year that required this adjustment. Although for an inventory write-off, that's unlikely to be sufficiently material to require further disclosure. Now, in our particular example, it's asking us about this restructuring of the company. Well, was the restructuring a condition that existed at the year end? Well, no, there was a plan, but there was no restructuring in progress. And because the conditions did not exist at the year end, there should be no double entry for the £5 million. However, given that the £5 million is probably immaterial and the owners of the company would want to know about it, we would need to have disclosure. So IAS 10 says for non-adjusting events, we disclose only, but there's no adjustment to the figures. So to answer the question, this is a non-adjusting event, and that's because the conditions did not exist at the year end. And for part 3, state the accounting treatment. So there is no accounting treatment, but in terms of the reporting treatment, we would disclose the restructuring. For the next part, the question says the statement of financial position of Iconic Limited, a bed manufacturer, included an intangible asset of £900,000 at the 31st of December 20X0 in respect of the development of a new sleep sensor. The sleep sensor entered production on the 1st of October 20X1, and 600,000 sensors are expected to be sold before it is replaced with a more advanced product in 3 years' time. The year ended 31st December 20X1, 30,000 sleep sensors were sold. So we're required to calculate the amount of the amortization charge in respect of this development expenditure for the year ended 31st December 20X1. So in this particular question, we're working out the amortization charge. And remember that amortization is the application of the accruals concept. And the accruals concept tells us that we should recognize our expenses and income when they are incurred, rather than when we actually spend the money. So in this particular case, we spent the money, and that's £900,000 on the 31st of December 20X0, but we need to show that cost over the life of the benefit of that asset rather than at the 31st of December. We don't really care when the cash was spent. So there are a couple of ways that we could do this. It tells us that we expect to replace this in 3 years' time. So one way of amortizing the intangible asset would be over 3 years. But they've also given us some other information that they expect to make 600,000 sensors over the lifetime of this asset, and so far they've made 30,000. So what we want to do then in terms of this accruals concept, remember accruals is also called the matching concept because we want to match the benefits with the costs. So what we want to do is for every time we sell one of these sleep sensors, we'd want to recognize the cost of one of those sleep sensors. So given that they've given us the actual numbers here for planned sales and actual sales so far, it would be more realistic to amortize this intangible asset using their production figures rather than simply spreading it over time. So they've given us that they've made 30,000 of the sleep sensors so far out of a total of 600,000. And if we multiply that by the 900,000 cost, that would give us an answer of 45,000 as the amount to amortize. So we're nicely spreading the cost of this asset over our production plan. So notice that one of the answers was 75,000, and that was a possible answer as well, because over the 3-year life of the asset, if we spread out the cost over those 3 years, that's going to be 300,000 per year. And it tells us that we started production on the 1st of October. So actually we've only got 3 of the 12 months in the first year. So 3 months multiplied by the 1 year out of the 3 that we're going to be using it, multiplied by the 900,000, would give us the 75,000 as a possible answer. And in the real world, either of these would be appropriate. But you can see here from the AAT's sample assessment that they're expecting us to use the production plan so that we have a more accurate amortization rather than some smooth time apportioning. In the final part of the question, it asks us to identify whether each of the following costs should be included in the cost of an item of property, plant and equipment. So we've got the cost of a maintenance contract, professional fees and installation costs. So let's have a look at IAS 16 to revise this. So we're looking at the elements of the cost. So what should be included in property, plant and equipment. And the standard tells us that we should include its purchase price, and that would include any import duties and non-refundable purchase taxes like VAT. But notice after deducting any trade discounts and rebates. We can also include any cost directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating in the manner intended by management. And we should also include any initial estimate of any cost of dismantling and removing the item when it comes to the end of its life. And we're also told some examples of what can be included as directly attributable costs, which was the second paragraph here. So we can include any cost of employee benefits, so there may be some pension costs for the employees who are directly used to build this property, plant, equipment. We can include site preparation, initially delivery, installation, testing, and professional fees. So based on the list that we've just looked at, so we can say that yes, professional fees, that can be included. Installation costs, yes, that was on the list. But the cost of maintenance, that wasn't on the list. That's going to be an ongoing cost, and that should be excluded from the cost of that property, plant and equipment.